Nat gas is rising and we're going to tell you where to invest. We're also going to rank our favorite offshore drillers and MLPs. It's time to go digging for value. Thanks for joining us. I'm Allison Southwick. I am joined by Taylor Muckerman and Joel South, energy analysts here at the Motley Fool. Our top story today, the U.S. is no longer number one. But that's a good thing. As the BBC and others are reporting, China is now the number one importer of oil and not the U.S. So Joel, what's the reason for us getting bumped from the top?
Well, first off, we're actually producing a lot more crude oil than China. However, we're just slightly beating them. Looks like China is going to be importing about 6.3 million barrels a day of crude. We're slightly under that at 6.1. So really, you're not seeing a whole lot of difference, but it is nice moving that way. If you look back out the numbers, we still are consuming a lot more crude oil than they are. We're just producing more. So, you know, it does help us on that scale, but we still have a ways to go. But luckily, we are starting to move and create or produce a lot more crude oil in the United States, which is always a good thing.
So do you see us to keep heading down the list, or is this kind of like we're going to always be jockeying 1 and 2?
I do see that. If you look at over the past few years, how we've been increasing, not only have we been producing more oil, but we're becoming a lot more efficient with our vehicles. With the CAFE standards, you're seeing the actual or the amount of gasoline that we're using is continuing to drop. You're not seeing that in China, as now you're seeing a lot of their middle class start growing. You're seeing a lot of cars, a lot more cars being purchased. One of their biggest sedans, the Ford Taurus over there. So you're seeing a lot more fuel use by them, where we are slowly on that decline. So you'll see us continue to stay a little bit lower. China, in the meantime, as they continue to grow, is going to need a lot more oil. And like we mentioned, we're producing a lot more. We have a lot of companies in the Gulf of Mexico and a lot of the shale plays that are producing so much crude oil. If you look at the fracking debate, China hasn't even entered that, so they have to go out and still look at the conventional resources that they have. So, you know, if they can move on and progress the same way we have in the unconventional resources, then I think that they might be able to see some declines in importation. But right now, I don't see that happening for quite some time.
So as an investor, how do you view this news?
Well, what I like is some companies like Occidental Petroleum. What's really nice about them, they're producing about 500,000 barrels a day, but they're also in a number of plays. They're offshore. They also have some international assets, which is nice, but they're really a diverse player in the United States, which is fantastic. Obviously, when you talk about United States E&Ps, one of the newer E&Ps after splitting off their refining is ConocoPhillips. They're another company that's really growing in the Gulf of Mexico, which is now turning into such a great play. Also in the Permian Basin, they're huge, and the Eagle Ford. So they're in a lot of oil-heavy plays. They have the balance sheet to do it. They have a lot of growth, so it's a safe play on a lot of growth. So ConocoPhillips is a great investment, I think, for long-term investors.
Another great fact about this is that we're exporting a lot more petroleum-based products after they've been refined, so that's a huge boon for the refiners here, which is probably why we're still importing a lot of oil, but then it's just immediately getting exported again in the form of gasoline, jet fuel, and petrochemicals. So the whole economy in the United States is really benefiting from this.
Any particular refiners you're keeping an eye on?
Some along the Gulf Coast. If you look at a Phillips 66 or Valero, both of those have access to the export markets down there in Louisiana and Texas, so I like them a lot.
All right, so for our next story, we're going to shale daily. According to the EIA, the price of natural gas should hit $4 next year. And as Shale Daily points out, the projection is higher than earlier estimates. So Taylor, first off, I need you to explain to me why the EIA stays open. Meanwhile, the people who inspect my food and my nuclear power plants are not working right now.
Well, first, it just shows how essential energy is, so keep tuning in. Also, I mean, companies around the world turn to the EIA for this data to not only benchmark for their corporate financial planning, but also major banks do this for their trading and things like that. So I have a feeling that if they did decide to shut down, there would be some people funding them on the side, because their French equivalent, IEA, is a pay, so they don't have quite the accessibility. So EIA is definitely a great resource to be interested in energy data.
All right, so now we can get back to the story, now that you've explained that to me. What is driving the price of natural gas here?
The Farmer's Almanac. They're expecting a terribly cold winter this year due to less solar activity and even some atmospheric and oceanography reasons in the Pacific and the Atlantic. So they're predicting brutal cold all across the country, and traders are kind of bumping that price up a little bit. So You saw prices 29 cents less per million BTU at this time last year, expecting $4, and we even talked about this on Tuesday. So natural gas, it was inevitable to rise, but it appears that it's happening in 2014.
Yeah, and like you said, we talked about this on Tuesday. So if you can, for those who didn't watch on Tuesday, although I'm sure everyone watches religiously, so but just in case, who then do you like as rising prices for natural gas?
Well, any low-cost producers, there's a couple that are already making money in natural gas, but if it goes up to $4 per million BTU, British thermal unit, you're going to see them profit even more. We talked about Cabot Oil and Gas and Ultra Petroleum having huge inventories, not just in the Marcellus, but also in Wyoming and down in the Eagle Ford in Texas. So I like both of those companies. And one we didn't talk about, but I like a lot, is Range Resources. I think investors lose sight of it because it is so expensive right now, wildly expensive if you look at some of its trading multiples. But the resources and acreage that it has in the Marcellus are world class, and they just continue to make money. So that's one that I really like.
Yeah, speaking on that, I mean, if you look last year, gas prices went up to about $4.40, and it was overall a pretty warm winter. So if you're right and Farmer's Almanac is right, you can see the prices creep up towards that $5 mark. And if that happens, I mean, recently we talked to Kinder Morgan CEO Steve Keen, and basically he's saying there's about 25 billion cubic feet a day that could come online at prices that actually are economical at prices under $5. So if you see that price going up, there's a lot of wells that have been drilled, so you can see a lot more production come on if that demand is in place.
Agreed.
All right, let's move on to our next story. Oil and Gas Journal is reporting on the outcomes of the Bipartisan Policy Center Conference on National Gas and Climate Change. The consensus seems to be that while natural gas can help with addressing global climate change, it probably won't. So why isn't natural gas going to solve all of our problems?
Well, right now, it's not as green as some people would like. And the reason that is, where a lot of natural gas is being drilled, they don't really have the infrastructure in place to really move a lot of the natural gas. So if that's the case, you have to flare it. Obviously, that is not good for the environment. Or if the pressure is not quite right in some of the wells, they'll have to vent it, where methane will have to be released into the atmosphere, and methane is significantly more potent than a lot of CO2. So you're seeing a lot of issues around that right now. Basically, where the places or the natural gas is being drilled, a lot of that is seeping, and there's still leaks. It's getting better, but that's still the case right now.
So are any companies trying to solve for this problem?
Yeah, there definitely is. If you look in the Bakken, this is an oil-heavy place, so everybody moved into that area either through rail or pipelines to move the crude oil. However, there's still a lot of natural gas when you're drilling for crude. So that natural gas right now is being flared up to, they're saying, $100 million a day is being wasted. So you're seeing companies like One Oak Partners that have a natural gas storage and gathering facility. They're building the pipelines to move it to the market. So there's people that are in that area trying to take advantage. And that is one of the companies that is really in a nice place to take that natural gas and move it into the Chicago area and other areas from there to really profit from it.
Now, the article goes on to quote an EPA administrator who says that one of the most positive changes we've seen is that companies are actually getting active in addressing climate change, and they aren't waiting for the government to kind of intervene or pressure them. So how much do you actually consider a company's dedication to climate change when you're investing?
I think this is pretty important. Obviously, it costs a lot of money to do this up front. One company that I like and one company that I actually purchased was Devon Energy. When they started drilling for oil and natural gas, they went and purchased a lot of recycling facilities and built them out when it wasn't required. But what that does is, as an investor, you know that that's on the forefront. So if regulations come down, they're already ahead of the game. They don't have to go out and spend a lot of capital expenditures to address that later on. Since that's already such a big focus, people are going to want to stick with them. The government's going to be more lenient towards for companies like that if they're working with them. And they are, like we mentioned, they already have everything in place, so they're way ahead of the game. So when regulations, they're going to happen sometime, or the industry really focuses on set standards, they're really going to lead the charge, and they'll be there to profit from it. Plus, you know, when you treat the environment right, you get a lot of investors that want to go and support them. So I think a company like Devon Energy has been ahead of the game, and I think it will benefit them and shareholders for the long term.
Agreed.
All right, so for our last story, we're going to go to the Financial Times, where copper miners and analysts or traders agreed that supply for copper will overtake demand next year. Copper has fallen by 30% since its record high in 2011. So, Taylor, is it a matter of supply is up, demand is falling, a little bit of both? What's going on?
Well, I think they're dead on with supplies rising a lot more quickly than requisite demand. You see companies like Southern Copper Corporation talking about spending $7.1 billion in Peru and Mexico alone on their copper mines between now and 2016, hoping to double their production. So if the demand doesn't keep up, they're moving from in the 600,000 tons a year up to 1.18 million tons a year, which is a pretty big leap for this company, trying to keep up with some of their bigger competitors in copper. So if this continues, I could certainly see why copper prices have remained as subdued as they have throughout 2013.
Yeah, so if we take a little trip in the Wayback Machine, going to kind of the peak of the housing crisis, one of the big stories, yeah, here we go. One of the big stories was that all of these houses that were left abandoned, people were going in and ripping out all the copper wiring, and I knew people who their air conditioners actually got like ripped out for everything. So falling copper prices is good news for our air conditioners. Who else is it good news for?
Well, you look at Chinese, I mean, they're expected to grow at 5 to 6% in their copper demand. So that could help some of these miners, but they're really outspoken in their desire to boost infrastructure spending on rail and also more affordable housing for around their cities, because they are trying to urbanize their population there a little bit. So I think it's great for the Chinese and any industry that's really looking to grow that requires copper.
Right. So then miners seem like the obvious answer for who's going to be hurt. I guess the question is, how badly are they going to be hurt?
I think a little bit worse in the near term. Obviously, Chinese demand is the driver for this industry. So if the prognosis is correct that Chinese will increase their demand for imported copper next year and into 2015, then definitely they'll start to pick up at near term. You're looking at a company like BHP Billiton, whose 17% of their revenue comes from copper, and they're slowly starting to work with Rio Tinto down in Chile to work on some water desalination techniques to improve their production capabilities in copper. So if the demand doesn't pick up like we expect, all that could be for naught for at least the next 5 years. So you look at those two companies, really might struggle. But I do believe in the Chinese infrastructure build out. They hold true to their word about building out their real estate market, so they're more than likely going to hold true to this word as well.
All right, well that covers it for the headlines. Now it's time to play Rank It. I'm going to give you guys a list of companies that are in the same space. You're going to rank them for me as far as how much you like them as an investment. So I'm going to give Joel, you are going to get the 3 largest MLPs, and they are Kinder Morgan, Enterprise Products Partners, and Enbridge. Rank them for me.
Well, I would rank them 1A, B, and C. Next question.
All right.
I'm curious.
It's a little bit of a cop-out, but how about you provide some color for us
if
here?
I had to actually pick them, I'll go in reverse order, so I leave the best for last. In the third place, a company that I really like is Enterprise Products Partners, and this is a company that really is focused on NGLs, and right now in the United States we have such a great advantage from low-cost natural gas over international competitors. This company has done a fabulous job building out the infrastructure, the pipelines to move a lot of the natural gas and natural gas liquids, and they have export terminals to move it overseas and take advantage of that. It's a company that also has shown that they outperform the market in a number of interest rate environments. So if you see prices rising, they're still strong. 36 quarters in a row, they've increased their distribution, so their yield's fantastic. And what I really like about them is over the long term, they have a knack of keeping their cost of capital low. They extend a lot of their debt maturities, and they've proven to be a winner over the long term. That said, I would have to put them at number 3. Obviously a great investment. In the number 2 spot, I would do Enbridge. This is another company that is extremely large, and they have a lot of good assets. But what I really like about this company is they have a lot of pipelines already in Alberta. It's an area where a lot of oil needs to be moved to the market. A lot of refiners down in the Gulf Coast need heavy oil. That's what the oil sands have. They have the infrastructure to move a lot of that. So I really like them. They have that. They have about $26 billion in commercial available backlog, which is fantastic as well. So with a lot of that that they have moving, it's a great company. They're looking for their earnings, their EPS to basically increase about 10 to 12% a year. Their distributions or dividends for Enbridge are basically on par. They're supposed to move in tandem with the EPS, so great growth there. Lastly, Kinder Morgan, I think, is really the best in this space. They're the 3rd largest energy company in the United States. They have a long history of increasing their distributions. KMP has been a fantastic company. That's one of the actual master limited partnerships in the family. And then El Paso is one that they recently purchased a few years ago. And what I like about them is they're basically a fixed fee toll road type of business. So they're really locking in the distributions that they're giving shareholders. So right now, I think that company, with the diversification that they have, is the best in the space, and they're just involved in so many different areas, really have been treating shareholders well. So that would be my number one.
All right, now it's your turn.
Okay.
I'm going to give you the 3 largest offshore drillers: Seadrill, Transocean, and Ensco.
Okay.
Rank it.
Well, number 1, I get to name drop like Joel did with Devon Energy. I own Ensco, so they're my number 1.
All right.
The dividend's been rising here, trying to keep up with Seadrill and Transocean. They're paying almost 4% yield. The stock hasn't done tremendously well this year, but with the outlook for offshore energy, I expect big things. They have the youngest fleet, tied with Seadrill, give or take a few months. And they also have the highest specification jackup fleet, which should see some great action here coming forward in the international market. You see Hercules has great competition in the Gulf of Mexico from the jackup perspective, but internationally in the South China Sea and in Saudi Arabia and things like that, the jackup market could be really big for Ensco. And they're the number 1 in customer satisfaction in a marketplace that really relies heavily on that since the BP and Transocean disaster in 2010. So I really think that this company's got a great head on its shoulders from that standpoint. And then that transitions right into Seadrill as my number 2, the company that they compete with for rig fleet age. And they're also really concentrating on a high specification, more in the ultra deep water space than Ensco, but they are doing really great things here. They're paying over an 8% dividend. A lot of that's funded by debt, which is one of my hesitations with this company. They use their cash flow to pay for operations, and then their dividend is paid through debt. So if the variable rates start to pick up, that could be something to watch out for this company. But I do like where the direction that they've been headed and the momentum that they've got behind them. So that's why they're number 2. Transocean, they pay a 5% dividend, so they're still paying investors quite handily. Carl Icahn likes them enough to get in there with a pretty big share, but I'm not too sure of his intentions. If they're short-term, investors might want to be careful. If they're long-term, he could be a great asset to this company, but I'm just unsure because when he came in, he really pushed for an unreasonable dividend, and if that happened again, you could see the company suffer. I think that's one of the reasons why their debt load and their margins are a little bit worse than their competitors. So I have my hesitations with them, a little bit more so than the other 2. So that's why I go Ensco, Seadrill, and Transocean.
All right, wonderful. Well, that's going to cover it for today. If you're looking for more energy sector analysis, we've got you taken care of at Fool.com. And you can also follow us at TMF Energy. Do it now. For Joel South and Taylor Muckerman, I'm Allison Southwick. Thanks for watching.